For Part B of the assignment, I will be covering the what, who, and how of reporting changes in shareholders' equity. The statement of changes in equity has many purposes in financial accounting. The statement provides a summary of accounts, compares opening and closing balances, and can be used to determine how a business's equity changed throughout the fiscal period. Companies use this data to determine if equity was income-based or investment-based. The changes in equity is a mandatory financial statement and must be provided. It is used by the government and auditing companies, and also used by executives to reflect on transactions and investments throughout the year. Owners and shareholders also use this statement to determine their financial position in the business. A corporation has a number of ways that can increase or decrease their equity throughout the year. Some of the ways they can do this is by issuing new share capital, receiving a net income or net loss for the year, distributing cash dividends, or the loss and depreciation of assets.
Now you're probably wondering, why do we report changes in shareholders' equity? Well, we report changes in shareholders' equity to basically update the books and get rid of old information in case shareholders have decided to buy or sell their equity. If this is not done, a shareholder's equity could result in an overstatement or understatement, and this would be violating the IFRS accounting standard. Therefore, we must report changes in shareholders' equity.
There are many reasons why we make changes in the shareholders' equity account. Today I'll be discussing two changes, which are dividend payment in cash and the sharing of shares. A cash dividend is a sharing of profits of the company with its common and preferred shareholders. These dividends are paid out monthly, quarterly, semi-annually, or on an annual basis. It is determined by the corporation and by its board of directors. Preference shareholders get first preference to any dividend that have been declared. Any dividends left over after paying the preferred shareholders are then shared among common shareholders. The amount of dividend being paid is based on the number of shares each shareholder has acquired or retained. Issues of new shares. There are various reasons why a company would issue shares. One main reason is to raise more capital for investment purposes. When more shares are issued, the number of shares outstanding in the shareholders' equity section will increase. This also would increase the cash balance of the company. Often there are conditions attached to these shares, such as unable to trade in or cash in for a particular period of time.
Example 1. On December 24th, stock was issued to investors for $32,000 cash. To complete this example, what we must do on December 24th is debit cash for $32,000 and credit common stock for $32,000. Example 2. On December 25th, the company declared and paid $10,000 cash dividend to stockholders of record. To complete this example, on December 25th, we must debit dividend and credit cash for $10,000 each.
For two word problems. Assuming the company has 1,000 shares outstanding at a price of $10 a share, that would be a value of $10,000. If the company decides to pay a 4% dividend on an annual basis, what would happen? The answer is, this would be a total of $400 that will be distributed to each shareholder based on their stock holdings. This would be a credit to the cash account as money is going out, and a debit to the shareholders account. Question number 2. Assuming the company has 10,000 shares issued and outstanding and decides to issue 1,000 new shares at a price of $12, what would happen? This would increase the total outstanding numbers of shares to 11,000 shares. This would also mean that the cash would have a debit entry of $12,000 and the equity account will be accredited by $12,000.